Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement. I am Peter Rashan, and along with me, as always, is Chicagoland's CFP certified financial planner Tim Stearns, founder at TJ Stearns Inc., providing us some guidance, clarifying and uncomplicating the financial world. And Tim, a lot of different topics out there that people are pretty worried about right now.
Peter, thanks for having me. And yes, we have a whole list here of things, so we should dive right into it.
Yeah, absolutely. But before we do, just want to remind you, ladies and gentlemen, listeners on the radio program, viewers on the podcast, if you have any questions, if you have concerns, if you would like to get a plan put together or just double check your current plan, Tim offers to do that with you. No cost, no obligation. You can get the help, the assistance, the guidance of a CFP, a certified financial planner, in getting your financial direction and getting that plan put together. All you need to do is pick up the phone and give a call. 800-640-2256. That's 800-640-2256. And Tim, I have heard other advertisements out there for the help of enlisting a CFP, a certified financial planner. That kind of time can go upwards of $1,000 an hour or more. And you offer to help people with no cost, no upfront obligation, because these big issues do scare a lot of people. You want them to get answers.
Exactly. And what I find is a lot of the public is misinformed. You know, the talks by the water cooler with family, with friends. There's a lot of bad information out there. And the internet doesn't seem to help that either. So if they come in here, they get the straight scoop right from the horse's mouth, as they say. And I think that that's been a good godsend to me to be able to help people like that. It feels good in that soul. And, you know, if you get someone the right answer that maybe they can take and run with it, or if they want to do it through us, it feels good.
Well, again, 800-640-2256, the number that you need to remember. And it is a little easier, Tim, than searching for something on the internet. You might get 12 million different results. 6 million of them are on one side, 6 million of them are on the other, and trying to determine what's actually appropriate for our situation with any given question sometimes can be a little difficult. So good to have somebody there, ladies and gentlemen, as your resource to hold your hand, again, uncomplicating the financial world. Tim, right now, we're hearing a lot about, and people are thinking, I think, more than they have in previous times, about being proactive about taxes. Are you hearing concerns there, and are you helping people be proactive?
Well, first of all, we have a CPA on staff, so that is his arena. Yes, I'm hearing that a lot, and I'm feeling it myself. Anytime you have the same party in charge of the executive branch and the legislative branch times two, it's concerning that they can do whatever they want. And so taxes have been at their all-time low for quite a while. And what you see is that they've passed two huge stimulus packages, including this infrastructure, right? That they've been bandied about. And basically my concern is that someone needs to pay for this. As they say, the chickens are going to come home to roost at some point. And I think that that's a real thing with taxes, because otherwise, how do we pay for that huge stimulus packages?
Well, Tim, the standard language in the financial world is always consult with your tax professional. However, every financial move has tax implications, right? And most savers and investors actually don't hear their financial advisor discussing any of those tax implications. It feels like it's an inherent conflict to me.
Right. Well, I mean, that's the good news with having a CPA here. He stays in his lane, as they say, which he deals with taxes, and some of the things we've talked about is, with a lot of our clients is doing Roth conversions and that type of thing. The question mark there is if they pass something by the end of the year, which who knows if they can, but if they do, You know, are they going to act like under President Clinton, where retroed back to the first of the year? You can't undo that, right? So you've already done a conversion. Now you're going to pay taxes at the new tax rates, which are going to be higher. Or is it going to be like when President Obama, under his legislation, they passed a tax rate up, you know, and basically they said, no, it's going to start like in January 1st of 2022, which I think would be fair. So we're kind of keeping our eye on those things. One thing I notice is that people are always reactive to taxes. They're not proactive. And a Roth conversion definitely makes you proactive. There's a lot of things you could be doing right now at these low tax rates, but we're keeping our eye on the situation.
We can default to the IRS's plan or be proactive and implement our own plan. Newsflash, defaulting to the IRS's plan, rarely ever in your best interest or the most cost-effective way of addressing taxes.
I would agree. And, you know, you and I have talked about this before. You have a plan for your dollars, and so do IRS, you know, and that's why you want to make sure that you're knowing exactly what you're getting yourself into. And, you know, I've seen some clients use different, you know, do-it-yourself kits. You know, one of my clients did it outside of our realm, and he cost himself $10,000. You know, to not have to pay a CPA, that seems like a really steep tax bill. So I would tell anybody that is having issues or wants to figure out what their tax bills are going to look like, you know, come see us and we can talk with Joe. And Joe is amazing. I've known him since we were 14. He does all my family's taxes, my own personally, and 90% of our clients.
There does seem to be a lot of confusion when it comes to taxes, and maybe it is because tax filing is retroactive, whereas the moves that you are talking about and discussing is a little bit more proactive.
Right.
And they're the questions of, can I even qualify to make a Roth contribution or a conversion? And if I do, when will I pay the tax? And then there's the potential changes that you've talked about with the tax law, tax code, tax brackets, and all the rest.
Right. So, you know, I don't think you want to go down that rabbit hole by yourself. And there's a lot of moving parts there. I had someone at our retirement class last week bring up that, you know, I'm going to have to contact you guys. There's 30 ways to activate my Social Security. Actually, there's 367 ways. So, I mean, you know, this is what I'm talking about. There's a lot of misinformation out there. Make sure you get it right so you don't screw yourself up, whether it's taxes, Social Security, or what have you.
We'll get in touch with the team from TJ Stearns Inc., including certified financial planner Tim Stearns, Chicagoland's CFP, by calling 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, you've talked about how there are different buckets for our money, a different tax plan associated with each bucket, but there is not a bucket that does not have some type of tax plan associated with it.
I would agree with that. So, I mean, we like tax-free, tax deferred, but obviously the biggest time bomb most people have, their biggest asset is their 401ks. You know, ERISA introduced that in the middle of the 70s, and you have people who don't realize how much they're going to pay in taxes. And then the other thing they say, well, taxes will be lower when I'm in retirement. Well, if you do a written income plan, you'll see that's probably not going to be the case unless they reduce taxes again. And I do not see that happening right now.
Now, Tim, because of the way that our tax system is designed, and in fact, it's progressive rather than simply proportional, is it the fact that those with higher balances, with larger nest eggs, actually are making a more costly oversight if they ignore this issue and are not proactive?
Well, you're kicking the can down the street, as they say, and so your family's going to pay it at some point. And I can't get over how many people don't know what the Secure Act is. You know, very educated people come in my office, and I say it to them. They look at me like, you know, I have a third eyeball, you know, and I explain to them, this is, you know, a real thing that, you know, if you don't help yourself, you're not going to help your kids either. So that's something that we do planning for. That, you know, obviously if they leave it to their children or an heir that's not their spouse, they're going to have to drain that account within 10 years.
Well, again, avoid that costly mistake. Be proactive in your planning. Give certified financial planner Tim Stearns a call, 800-640-2256. That's 800-640-2256. Tim, perhaps that third eye would be helpful. I've heard in mythology the third eye helps you see the future. Well, they've proposed a lot of tax law changes. They've talked about a lot of different tax law changes, including changes to the income taxes, changes to the corporate taxes, changes to capital gains, changes to the estate law taxes. All of those proposed changes, if things happen in the future, we can position ourselves to be in better shape if we do take a proactive approach. Now, we don't know the future, but with all that talk, it seems to me like now is the time to actually take some action.
Well, honestly, where there's smoke, there's fire. And I really do see something happening there. The estate tax, I can't believe some of the people we've met that have not addressed that. You know, they say, oh, I'm going to be fine. No, if it's going to sunset in 2026 to 5 million, right? And then President Biden spoke of moving it to 3 million when he was running for office. And I've heard it to go as low as $1 million now that he's in office. And I'm not getting political. That's what he said. So that's, you know, and he's got the two houses on it, House of Representatives and Senate, usually vote with him. So where are we looking? I mean, I see that being a changing moment that you need to get a hold of.
To me, Tim, if you are in a financial situation where today you can evaluate and say, I'm fairly financially confident, I think that I am in good shape, then in all likelihood, if your goal with that is more and further growth on your money, you will probably run into an area where income taxes, capital gains taxes, and maybe eventually estate taxes are an issue that you are going to likely be facing.
Right. Exactly. So why wouldn't you not get ahead of it? You know, and reading stuff on the internet is not getting ahead of it. You know, we always talk with some of our perspectives that come in here. Don't let inertia take over where you're, two powers going against each other, you go nowhere. So, that's, and procrastination kills a financial portfolio. And, you're going to leave that mess to your kids. That shame on you is what I say.
Well, we've got another big topic, Tim, that a lot of savers and investors are worried about. And that is, while it's a good thing on one hand, the market has done fabulous for us. It has really come a long way and helped many of us build a lot of wealth. But we're worried that it may change direction. Market corrections, market volatility. We're hearing a lot about it. Kind of like with the concern of taxation, and we can be proactive and maybe consider some Roth strategies. With the concern of market volatility, Tim, are there some proactive strategies that a saver or investor can be more prepared there?
Well, I would tell you with a market correction, one of the things you should have are stop losses. When I ask that to our retirement classes or any of the seminars that we have, you could hear a cricket. People look at you like, what are you talking about? Put a stop loss in so you don't lose money. It's a pretty simple concept. Well, my advisors never talked to me about that. Well, that's terrible. The market corrects every 7 years on average. We're at 12 and a half years of a bull market. What's the next step? I mean, come on. All good things do come to an end for a while. I hope it's not catastrophic, but these people are just forgetting about what happened in 2007 through 2009, where they lost about 50% of their portfolio. If you're 60, how do you make that up?
Mm-hmm.
You're gonna work another 10 years when you didn't plan on doing that. That's terrible.
You've shown me an eye-opening chart, Tim, and it looks at the last 100 years of market history, and it details 14 different major market corrections. And on average, the drawdown during each one of those 14 different times, on average about one every 7.25 years or so. But the average loss during those downturns was just under a 40% loss. So 40% of our portfolio in jeopardy of disappearing, and over an average retirement, maybe 2, 3, 4 different times if history does bear with us and continue with that kind of frequency and pattern. And I don't think a lot of retirees want to go through the roller coaster of losing a quarter, 30%, 40% of their wealth, even one time in retirement.
Well, and I hope they remember that now they're not funding anymore, right? They're in retirement. They have a finite amount of money that was in their 401ks or IRAs, and they're not funding anymore. They're golfing. Every day is a Saturday. They're living the life of Riley, as they say in Chicagoland, right? Just having a good time. Well, guess what? Then get a stop loss in there. So you're not having to go back to work or be a Walmart, welcomer, and that's what the joke is always in these retirement classes. People, well, I don't want to have to work at, Walmart when I'm 70 greeting people. Well, then make sure that you get ahead of it and make sure you're properly prepared.
Tim, there are some advisors out there that were kind of proactive and maybe pulled folks back as coronavirus was beginning to hit American soil, that were worried about the election year cycle, and even some that during the Great Recession maybe pulled clients back a peg or two with how aggressive they were being invested, how much risk they were taking. But even the best advisor may not have the time or the ability to do that. There have been some events, some downturns that have happened overnight, and by the next morning, the market is way down. 9/11, when that happened, hard to believe the 20th anniversary just recently of that passed. But I remember back when that happened, there was like 2 weeks where the markets were closed. You couldn't take that kind of action. Are the strategies that you're talking about going to help to protect and safeguard during those kind of circumstances?
Well, if you remember when the markets did reopen, it was a free fall. So yes, they will. 2000 through 2002, the market dropped another 50%. So in the last 20 years, we've had 50% drops over 3 years at a time. So yeah, the stop losses would kick in and you get out.
And then, Tim, with those different instances that you've shown me on the chart, the 14 different downturns, many of them, kind of coronavirus was the one exception. Many of them took years to recover from, because if you take a 40% loss, it's not likely, it doesn't happen often, that you just rebound the next month like we did with coronavirus and the COVID pandemic. Right. Most of those downturns took subsequent years to make the progress back to just get back to break even. Again, I think that rightfully so, a lot of savers, a lot of investors are sort of nervous about this right now. You're helping to balance that and make sure that your clients are appropriately invested only for the money that they can afford to or are willing to put on that table.
Right. And what I've noticed is people don't understand that mutual funds are not the silver bullet. I don't care if it's target date, it doesn't matter. One of the slides in our retirement class is a Vanguard fund from 2010 that lost 39.4%. So these are things that really happened in real life in 2008. So one of the things with mutual funds is, again, they don't have stop losses. The money managers have to stay 80 cents on a dollar involved in the market. That is a law, the Investment Company Act of 1940. No one knows about that. So I'm all for Vanguard, Fidelity, where you can save money. That's fantastic. But you should talk to them about putting a stop loss in. And they're going to look at you like, what are you talking about? And that's because they can't really do that. Now you can call them and say, get me out. But let's say you're overseas or something, the market's dropping precipitously. You're on the hook. That's on you.
Well, again, if you would like to review and evaluate your portfolio, the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, those are all part of the Protect and Grow plan, the review, the strategy session that Tim Stearns offers for listeners to the radio program, for viewers of the podcast, at no cost, with no obligation. All you need to do is pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. We talked briefly about the different buckets of money. Tim, you've mentioned a time optimized portfolio as a means of allocation. When we consider our risk level, the amount of risk that we are willing to take with a certain dollar, how important is it to consider the time horizon that we have until we intend to actually use that dollar?
Well, it's very important, and that's why you do a written income plan. I'd say 95% of Americans don't have a plan. And I'm not talking about where these advisors project out that the market's going to do 8% at a clip or 6 or whatever number you want to do. I don't care the number. The market does not work that way. This was your grandfather's stock market when it went straight up like a balloon. What have we dealt with? We call it the W. It goes down, up, and you want to get off that roller coaster at the right time. Well, make sure that you understand that you should have stop losses. You should have a written income plan. You should know where's your money coming from that you're going to pay your bills. That's huge.
I heard another financial talk program, and they were mentioning that they could help guide you on the whitewater rapids of the market. And I thought to myself how in retirement, I might not want the whitewater rapids, guide or not. I'm thinking more fishing on Lake Placid.
Well, or maybe the lazy river,
Right.
just very milquetoast.
Just
I would agree.
enjoy the ride, right?
Right. Exactly. You've earned it,
Well, again, I think that, Tim, you help to address the risk tolerance of your clients. You help to really review that. Oftentimes, you find that their intended risk tolerance, or how much risk they believe they have, isn't actually what they have reflected and inherent in their portfolio.
Well, exactly. Because of the 12.5 year run in the bull market, I've seen portfolios that went upside down how they were supposed to be. A 60-year-old who has 60% in stocks and 40% in bonds, using asset allocation. And that's not what they meant to do. And they haven't rebalanced, and the advisor hasn't. I was with a gentleman who has $3.5 million. And in the 2 months I looked at his statements, the company that he was with made 4 trades, and $3.5 million. That is shame on them. That is terrible. You need to be active in this market, tactical, strategic. You can't just buy and hold. That era is absolutely dead. You need to have something where you're, dynamic and always changing with what's going on out there.
And in fact, Tim, they tell us to be buy and hold. But one thing I've noticed is that with the mutual funds, you can actually look up if they are following that model, the
Turnover.
internal turnover. And
Exactly.
oftentimes these mutual funds are turning funds over. Half of the funds will be sold within a given year, maybe 2 times, 200%, 300, 400% internal turnover ratio. And I know they must stay invested, but that's a lot of buying, selling, and trading for a buy and hold philosophy.
Right. And that's one. It's funny you bring that up. That's one of the lessons that's the homework that I give in between our 2 retirement classes, which again, we're having again in person. And if people don't want to attend in person, they can do a Zoom. But my point is that they think that the internal, the 12B1 fees are it. No, there's trading costs, and that's the turnover that you're speaking of. And I've seen some that are over 200%. Well, that's 2% that you're adding onto a portfolio that you thought you're paying 0.12%.
Well, if you would like to attend that class, by the way, upcoming classes throughout the area at local colleges is where Tim most commonly teaches his Rethink Retirement classes, but now online as well through the ease, the convenience, the safety of technology. If you'd like to attend virtually, you can do so. But you do need to find out when and where those are. Pick up the phone, give Tim Stearns a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, we've talked about taxes, and if we are worried about tax changes in the future, there's an opportunity to be proactive. We talked about the market, and if we are concerned with where the market is versus where we feel it may go into the future, there are ways to be proactive to address that. Another big topic that we are hearing some concern about right now is inflation. Similarly to those other 2, are there things that a saver, an investor, can do to help to address and maybe combat against inflation?
Well, first of all, you're talking about the silent thief, inflation. And, people don't realize that. When we do a written income plan, we build that in there, inflation. We explain to people your dollar needs to double every 22 years. And if it doesn't, you're behind the 8 ball. One of the things we have as kind of a goof in our office is that I have the 1976 Sears catalog. And then there you can buy 4 tires for $200 installed at Sears. All right. Nowadays, within the last 8 months, I bought my son tires, nothing extraordinary, just safe tires at a discount tire place, no less. And they're $800.
800. Yeah, I was going to say at least 800.
Right. And you're looking at what, that's inflation. That's a perfect example of that things have gone up.
No pun intended with it being tires. Boom, boom.
Exactly. But, the thing I laugh at is that people sit there and go, well, Social Security is going to have a cost of living adjustment. The cost of living adjustments that they give us are very poor. What they do is they look at the consumer price index. They strip out the costs like fuel, food, And then they say, well, no, there hasn't been inflation. We'll give you X instead of Y. And that's not worth a darn. So you have to put the onus on you to make sure that you're staying up with inflation. If you have a written income plan, that certainly does that.
We've talked about the value of having that plan, the protect and grow plan, the written retirement income plan, having the income allocation. Once again, certified financial planner, CFP Tim Stearns, Chicagoland's resource, offers to help you put that together. Creating the plan with you, your plan, is that protect and grow plan and that strategy session process. All you need to do to get started is pick up the phone and give a call, 800-640-2256. That's 800-640-2256. And Tim, along with that offer, as well as the classes that you offer, the instructional and educational opportunities, you also offer a book to get started and get the right mindset for what we face in today's retirement.
Right. And that's called Income Allocation by my good friend, David Gaylor. The book really crystallizes how a retirement works nowadays. Most of us don't have pensions. If you're lucky enough to have one, that's great. But if you don't, which is most of us, again, you were introduced to ERISA. The biggest thing you have is your 401k besides your house, right? So you need to be cognizant of the fact that you need to figure out how to dissect that. You know, when you're in accumulation, when you're younger, that's fine. But when you're in decumulation, where you're distributing and distribution, your money, you don't have an endless stream like a pension would. You have to be smart and on top of it.
Well, again, if you would like help and assistance, if you would like the guidance and perspective from a qualified, experienced professional, a certified financial planner, CFP, with that fiduciary responsibility to your best interest whenever crafting and creating that plan, pick up the phone, give Tim Stearns a call, 800-640-2256. That's 800-640-2256. We've talked about a number of the big concerns in today's economic environment: taxes, inflation, the market itself. But Tim, even just for kind of routine things, just to make sure I've got a plan together, that's one of the big reasons that people give you a call, trust, rely on your guidance.
Well, one of the things I always ask people, just as an analogy for them, I point someone out in the retirement class and I say, hey, I'm a contractor. I say that I'm going to redo your house for you. And you say, well, let's see some blueprints. I say, no, we're just going to wing it. And I say, would you hire me? And they say, absolutely not. I'm like, well, that's what people are doing in retirement. They're winging it. They're taking out too much, too little. They don't know what taxes are doing. They don't have a plan. And you have to have a plan in this world, because if you don't, you're doomed.
Well, again, if you would like some help, some assistance in creating that plan, even if you have a plan, completing the plan, spot checking it, working through it to make sure that there are no holes left unaddressed, stones that have been unturned, pick up the phone, give a call. Tim Stearns here to help and assist with the perspective of a certified financial planner. You can be more confident in your financial future. 800-640-2256. That's 800-640-2256. And if you'd like that book, Income Allocation, the first 10 callers with at least $500,000 saved for retirement, this book is essential for you. It is today's modern retirement planning strategy guide book. It is a reference for advisors and savers and investors alike looking to understand how to structure the assets to address many of today's top economic concerns. Give a call, request Income Allocation, request the time to sit down with Tim Stearns, 800-640-2256, 800-640-2256. As always, Tim, we appreciate the time and the guidance and perspective that you share with the Chicagoland area savers and investors.
Well, Peter, thanks for having me again.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.